Welcome back to Crypto Miners Rigs. If you have spent any time in the world of cryptocurrency recently, a certain number has likely appeared on your screen. You have probably heard it mentioned in videos, read it in headlines, or seen it in excited online discussions. That number is $250,000. People are claiming a single Bitcoin will one day be worth $250,000. This is a massive figure, one that can generate a great deal of excitement. It promises incredible returns, a future where early adopters are rewarded for their foresight and conviction. For many, it feels like a glimpse into a radically different financial landscape. This number, however, can also be profoundly confusing, especially if you are new to Bitcoin and the broader digital asset space. Where does a prediction like this even come from? It sounds less like a calculated forecast and more like a wild guess pulled from thin air. The sheer scale of it can feel intimidating, making the entire subject of cryptocurrency seem inaccessible or purely speculative. It raises immediate questions. Is this based on real analysis, or is it just baseless hype designed to attract new buyers? How can anyone possibly predict a price with such confidence when the market is famously volatile and unpredictable? Today, we are going to step away from the hype. We are not here to tell you whether Bitcoin will or will not reach $250,000. Our goal is not to sell you on a specific price target or to encourage you to make financial decisions based on speculation. Instead, we are here to provide clarity. We will pull back the curtain and show you the mechanics behind these bold predictions. We want to explain the models, the reasoning that lead analysts and investors to arrive at such figures. This is about education, not prognostication. The aim is to empower you with knowledge so you can think for yourself. Our focus will be on the fundamentals. We will explore where these numbers originate, breaking down the assumptions, the logic involved in a clear, step-by-step manner. More importantly, we will discuss what these predictions actually mean in the grand scheme of things. Finally, we will shift the conversation to what you should really be focusing on. Beginner, small-scale miner. The answer is not a single price point, but a deeper understanding of the system itself. We will navigate this topic together, providing a calm, no-hype explanation that prioritizes foundational knowledge over sensational claims. Section 1. Models, not magic. The anatomy of a prediction. When you hear a bold prediction like Bitcoin will reach $250,000, it's natural to be skeptical. It sounds more like a lottery number than a serious financial forecast. However, these figures are rarely just pulled out of thin air. They are typically the output of sophisticated economic models. Analysts and researchers build these models to try and understand the fundamental forces that drive Bitcoin's value over the long term. Instead of guessing, identify key variables, feed them into a framework, generate a potential price based on a set of assumptions. These models are not magical. They are structured attempts to bring logic to a complex and emerging asset class. Analysts build these forecasts by looking at a specific set of factors that are unique to Bitcoin's design and its role in the global economy. One of the most critical factors is its fixed supply. There will only ever be 21 million Bitcoin created. This absolute scarcity is programmed into its core code, making it fundamentally different from traditional currencies, which can be printed without limit by central banks. This predictable supply is a cornerstone of almost every long-term valuation model. Another key element is growing demand. As more individuals become aware of Bitcoin, corporations and even financial institutions become aware of Bitcoin, the number of people wanting to own it increases. This demand comes from various sources. Some see it as a long-term store of value, like digital gold. Others use it for transactions, and some are interested in the technology itself. When you have a growing number of people wanting to buy an asset with a strictly limited supply, basic economic principles suggest that the price will face upward pressure over time. The models attempt to quantify this growing demand and project its impact on price. However, it is crucial to understand that these models are not crystal balls. They are not guarantees of future performance. They are scenarios. A prediction of $250,000 for Bitcoin is essentially a statement that says, if demand grows at a certain rate, if institutional adoption continues, and if its role as an inflation hedge solidifies, then this is a plausible value, right? It is one possible outcome among many. The models are tools for thinking about the future, not for predicting it with certainty. They help us frame the potential, but they cannot account for unforeseen events, changes in regulation, or shifts in market sentiment. This is why, for beginners and miners, fixating on a single price target can be a distraction. Chasing a specific number can lead to emotional decisions like buying into hype or panic selling during a downturn. The real, sustainable path is to focus on the underlying principles. Instead of asking, will Bitcoin hit $250,000? A better question is, why do people believe it has long-term value? Understanding the concepts of digital scarcity, decentralized networks, and the role of mining is far more valuable than memorizing a price prediction. This knowledge allows you to build a solid foundation and navigate the space with confidence, regardless of short-term price movements. Section 2. The cornerstone of value, absolute scarcity. One of the most fundamental and universally agreed upon factors in every Bitcoin valuation model is its fixed supply. The Bitcoin protocol dictates there will only ever be 21 million Bitcoin created. This isn't a company policy or a government promise. It is an immutable rule enforced by a global, decentralized network of computers. No CEO, board of directors, or central bank can decide to create more. This concept of absolute, provable scarcity is the bedrock on which all long-term price theories are built. It makes Bitcoin a unique asset in a world where nearly everything else can be diluted, from national currencies to company stocks. Think about traditional currencies, like the US dollar. Central banks can, and frequently do, increase the money supply to stimulate the economy or manage debt. This process, often called money printing or quantitative easing, means each individual dollar becomes a smaller piece of a larger pie, losing purchasing power over time. This is what we experience as inflation. Bitcoin was designed as a direct response to this system. Its supply schedule is predictable and unchangeable. Everyone knows exactly how many Bitcoin exist today and how many will be created in the future, right up until the last one is mined around the year 2140. For modelers, this fixed supply is the one constant in a sea of variables. With any other asset, analysts must predict not only demand, but also how supply might change. If the price of gold rises, mining companies will invest more. If a company's stock price soars, it might issue more shares. With Bitcoin, this variable is removed. The supply is fixed. Therefore, long-term price movement becomes almost entirely a function of one thing: demand. This is why you often hear Bitcoin referred to as digital gold, right? Its value proposition is anchored in the same principle of scarcity that has made gold a trusted store of value for millennia. However, Bitcoin's scarcity is even more perfect. It is mathematically absolute, whereas nobody knows for sure how much gold is left in the Earth's crust. It provides a firm foundation upon which they can build their scenarios. If demand for a verifiably scarce asset increases, its price, measured in inflationary currencies, must logically rise. While a fixed supply is the anchor, it is the growing demand that propels the ship. Scarcity alone does not create value. An asset must also be desired. Bitcoin's demand comes from a diverse and expanding group of participants from all over the world. In the early days, demand was driven primarily by a small community: cryptographers, cypherpunks, technologists who were fascinated by the idea of a decentralized digital currency. They were the pioneers who saw its potential long before it had any significant market price. Their demand was ideological and experimental, focused on the technology's promise rather than financial gain. Over time, the sources of demand have broadened dramatically. Today, individuals across the globe buy Bitcoin for a variety of reasons. Some see it as a hedge against inflation and currency debasement in their home countries, a way to protect their savings from losing value. Others use it for censorship-resistant transactions, sending money across borders without relying on traditional banks. A growing number see it as a long-term investment, a new asset class with asymmetric upside potential that could become a significant part of the future financial system. This retail demand continues to form a strong, grassroots base of ownership. More recently, a powerful new source of demand has emerged: institutional adoption. Corporations, hedge funds, asset managers, pension funds. When a company like MicroStrategy or Tesla puts Bitcoin on its balance sheet, it signals a major shift in perception. Even more significant is the launch of spot Bitcoin ETFs, exchange-traded funds. These regulated financial products make it incredibly easy for traditional investors to gain exposure to Bitcoin through their existing brokerage accounts, opening the floodgates for trillions of dollars in managed capital to potentially enter the market. This institutional layer is what many of the larger price predictions, like $250,000, are heavily based on. The models project that even a small allocation, say 1% to 5%, from the vast pool of global institutional assets would create massive demand-side pressure. These institutions tend to buy with a long-term perspective and in large quantities, effectively removing a significant amount of Bitcoin from the circulating supply available for trading. When you combine this powerful new wave of demand with Bitcoin's absolutely fixed supply, the mathematical case for a much higher price becomes clear. To understand why models for Bitcoin can produce such large numbers, it is crucial to recognize how fundamentally different it is from traditional assets like stocks. When you buy a stock, you are purchasing a small piece of ownership in a company. The value of that stock is theoretically tied to the company's future performance. You analyze its earnings reports, its profit margins, its market share, and the quality of its management team. A company has a CEO, a board of directors, and a balance sheet with assets and liabilities. Its value is derived from its ability to generate cash flow for its shareholders. Bitcoin has none of these things. It has no CEO to make executive decisions, no board of directors to answer to, and no quarterly earnings reports to scrutinize. It doesn't generate revenue or pay dividends. It is not a company. It is a decentralized protocol. Trying to value Bitcoin with the same tools you would use for a stock like Apple or Amazon is like trying to measure water with a ruler. It simply doesn't work because the underlying nature of the asset is completely different. Bitcoin's value does not come from a centralized entity's ability to produce profit. So, where does its value come from? As we've discussed, it emerges from a unique combination of three core properties: scarcity, utility, trust. Its scarcity is absolute and mathematically enforced. Its utility comes from its function as a censorship-resistant, permissionless, global value transfer network, and a potential store of value outside the traditional financial system. It allows anyone, anywhere, to send and receive value without needing an intermediary. This utility is real and is used by millions of people around the world every day, especially in places with unstable political or economic environments. The final piece, and perhaps the most important, is trust. The trust in Bitcoin is not placed in a person or a company, but in mathematics and code. It is trust in the decentralized consensus mechanism, which has operated without interruption and has never been hacked for over a decade. It is trust in the predictable issuance of new coins and the security provided by a massive global network of miners. This distributed trust is what gives the network its resilience and integrity. Models that project high valuations are essentially betting that as more people understand and trust this system, its utility and the demand for its scarce units will grow exponentially. After exploring the factors that go into these big predictions, scarcity, demand, Bitcoin's unique nature, it is vital to circle back to a critical point. These are not guarantees. A price prediction of $250,000 is not a promise etched in stone. It is a scenario. It represents one possible future trajectory among an infinite number of alternatives. These models are sophisticated, but they are still just tools for thinking about possibilities. They are built on assumptions, and if those assumptions turn out to be wrong, the prediction will be wrong as well. The future is inherently uncertain, and no model can ever fully capture its complexity. Think of a weather forecast. A meteorologist uses complex models to predict that there is an 80% chance of rain tomorrow. This is a highly educated and data-driven assessment, but it is not a certainty. Unforeseen variables can change the outcome. Similarly, a Bitcoin price model might assume that institutional adoption will continue at its current pace, regulations will remain favorable, or no superior technology will emerge to challenge Bitcoin's position. Any of these assumptions could change, altering the price trajectory in ways the model could not anticipate. It is a map of a potential route, not a photograph of the destination. This is why focusing on the why behind a prediction is more empowering than focusing on the number itself. Understanding the logic of scarcity meeting demand allows you to evaluate the market from first principles. It helps you build your own conviction based on the fundamentals of the network rather than borrowing someone else's conviction in a price target. This approach makes you more resilient to market volatility. If you understand the underlying value proposition, you are less likely to be shaken by a sudden price drop or to get carried away by irrational exuberance during a price surge. Ultimately, these large predictions should be seen as discussions about potential. They are explorations of what could happen if certain trends continue. They are useful for framing the scale of the opportunity and for understanding the forces at play. However, they should never be treated as investment advice or as a sure thing. The real value for a beginner, the real value for a miner, is not in believing a prediction, but in understanding the mechanics that make such a prediction plausible in the first place. That knowledge is your most valuable asset, and it is the only one that is guaranteed to grow as you continue your journey in this space. Now that we have established the core principles of scarcity and demand, let's transition to one of the most important and often misunderstood aspects of the Bitcoin network: mining. To truly grasp the supply side of Bitcoin's economic equation, you must understand where every single Bitcoin comes from. Unlike dollars, which are printed by a central bank, or stocks, which are issued by a corporation, new Bitcoin are brought into existence through a process called mining. This is not a metaphorical term. It is the functional engine room of the entire network. Miners are the participants who dedicate computational power to solve complex mathematical puzzles. When a miner successfully solves one of these puzzles, they earn the right to add the next block of transactions to Bitcoin's public ledger, the blockchain. Think of it as adding a new page to a global accounting book that everyone can see. For their effort and the electricity they consumed, the protocol rewards them with a specific amount of brand new Bitcoin. This reward is how new coins enter the circulating supply. It is the only way new Bitcoin are ever created. Every single fraction of a Bitcoin in existence today began its life as a reward to a miner somewhere in the world for contributing their work to the network. This process is profoundly deliberate. The creation of new Bitcoin is not random or chaotic. It is slow, predictable, and resource-intensive. The difficulty of the mathematical puzzles is automatically adjusted by the network approximately every 2 weeks. The goal is to ensure that, on average, a new block is found and a new batch of Bitcoin is created roughly every 10 minutes. This steady rhythmic issuance is a core feature of the protocol's design. It ensures that the supply grows at a predictable rate, preventing any single entity from flooding the market or manipulating the creation of new coins for their own benefit. Understanding this mechanism is crucial because it directly connects computational work to the creation of value. Miners are not just guessing numbers. They are performing a vital service. They are the decentralized mint of the Bitcoin economy, but their work does more than just create new currency. They are simultaneously validating transactions and securing the network from attack. By understanding that every Bitcoin is born from this energy-intensive and competitive process, you begin to see that the supply has a real-world cost. It isn't just conjured out of thin air. It is earned through proof of work, forming the foundation of Bitcoin's supply dynamics. The mechanism that ensures Bitcoin supply inflation decreases over time is called the halving, and it is one of the most significant and widely anticipated events in the cryptocurrency world. Approximately every 4 years, or more precisely every 210,000 blocks, the reward that miners receive for adding a new block to the blockchain is cut in half. This event is written into Bitcoin's core code and has happened like clockwork since its inception. It is an automatic, non-negotiable reduction in the rate at which new Bitcoin are created. This event serves as a periodic and powerful reminder of Bitcoin's engineered scarcity. Let's follow the timeline. The first halving occurred in November 2012, when the block reward dropped from 50 BTC to 25 BTC. The second took place in July 2016, reducing the reward to 12.5 BTC. The third was in May 2020, bringing the reward down to 6.25 BTC. The most recent halving happened in April 2024, cutting the issuance to just 3.125 BTC per block. Each of these events instantly sliced the daily production of new Bitcoin in half. For instance, before the 2024 halving, about 900 new BTC were created per day. The day after, that number permanently dropped to around 450 BTC per day. This event is essentially a pre-programmed supply shock. Imagine if, one day, the world's gold mines suddenly announced that, from now on, their yearly production would be permanently cut by 50%. The price of gold would almost certainly react dramatically to such a sudden constriction in new supply. With Bitcoin, this supply shock is not a surprise. It is a known and anticipated feature. Yet its economic impact is profound. While the demand for Bitcoin might remain steady or even continue to grow, the flow of new coins available to meet that demand is abruptly and permanently reduced. Historically, the periods following each halving have been associated with significant upward price movements. While past performance is no guarantee of future results, the economic logic is compelling. The halving event puts a direct and quantifiable squeeze on the supply side of the market. Miners, who often sell some of their newly minted Bitcoin to cover their operational costs like electricity, suddenly have half as much to sell. This reduction in sell pressure, combined with ongoing or increasing buy pressure from investors, creates a powerful tailwind for the price. The halving is the protocol's way of methodically tightening the screws on supply. For most of its history, Bitcoin was primarily a retail-driven phenomenon. Its ownership was spread across a global community of individuals, early adopters, technologists, investors, people seeking an alternative to their local currencies. The buyers were people like you and me. While these retail participants remain the heart and soul of the network, a new and profoundly powerful class of buyer has recently entered the scene: institutions. This term refers to large-scale financial entities, corporations, hedge funds, asset managers, pension funds, and even some governments. The arrival of these players marks a significant maturation of the Bitcoin market. For years, institutions largely stayed on the sidelines. Too volatile, too unregulated, too strange. They require extensive due diligence, regulatory clarity, and trusted custodians. The landscape began to shift when pioneering companies like MicroStrategy started using Bitcoin as a primary treasury reserve asset. This was followed by the creation of regulated financial products, most notably the spot Bitcoin exchange-traded funds in the United States. These ETFs in particular have been a game-changer. They provide a familiar, regulated, and easy-to-use bridge for institutional capital to flow into Bitcoin. An asset manager overseeing billions can now gain exposure with a simple ticker symbol, just like buying Apple or an index fund. They no longer need to worry about technical complexities, private keys, digital wallets, self-custody. This removes a massive barrier to entry, opening the floodgates for a torrent of capital. The scale of this capital is difficult to overstate, dwarfing the retail market by orders of magnitude. This institutional demand is fundamentally different from retail demand in both size and nature. A retail investor might buy a few hundred or a few $1,000s worth of Bitcoin. An institution might allocate hundreds of millions or even billions. Their investment thesis is typically long-term. They are not day trading or trying to time the market's peaks and troughs. They make strategic allocations based on multi-year or even multi-decade outlooks, viewing Bitcoin as a hedge against inflation, a portfolio diversifier, or a stake in a burgeoning new technology. This new class of buyer changes the entire game. The most immediate and powerful effect of institutional buying is on the available supply of Bitcoin. When a large institution buys Bitcoin, like an asset manager or a corporation, they typically do so with a long-term holding strategy. They are not buying today with the intention of selling next week or next month. Their goal is to hold the asset on their balance sheet or within their fund for years, even decades. This means every Bitcoin they purchase is effectively removed from the active, circulating supply, the supply that is readily available for trading on exchanges. This has a profound impact on market dynamics. Think of supply in two buckets: the liquid supply and the illiquid supply. Institutional buying dramatically accelerates the movement of coins from the liquid bucket to the illiquid bucket. As these large entities absorb vast quantities of Bitcoin and transfer them into secure, long-term cold storage, the pool of coins available for new buyers to purchase shrinks. This phenomenon is often referred to as a supply shock or a supply squeeze, and it happens on a scale retail buying alone could never achieve. This creates a situation where even a small increase in new demand can have an outsized impact on the price. With fewer coins available for sale on the open market, new buyers must compete more aggressively for the limited supply. What institutional adoption does, with a much higher degree of certainty, is raise the long-term price floor. It builds a progressively higher and more solid foundation beneath the market price, making catastrophic, protocol-threatening price collapses far less likely. Think of it this way. Every time a major institution makes a long-term allocation to Bitcoin, they drop a concrete anchor at a valuation level. They are unlikely to sell in a severe downturn, so they create a strong base of ownership that supports price. As more anchors are dropped at higher valuations, the potential downside becomes more limited. This rising price floor matters more to long-term investors and beginners than chasing a speculative price ceiling. A high ceiling is exciting, but a strong floor provides security and confidence. For beginners, entering becomes less about timing the bottom and more about accumulating over time with confidence. So while 250K is plausible from institutional demand meeting scarce supply, it shouldn't be the central focus. The real story is structural change in the market. Institutions aren't guaranteeing a price target. They're de-risking the asset and making it a permanent global financial feature. They are pouring the concrete foundation. The skyscraper's height is unknown, but the foundation gets stronger every day. Section 1. Shift your focus from price to principles. We began this discussion with a single, captivating number: $250,000. We have explored the models that generate such predictions: absolute scarcity, growing demand, and institutional adoption. However, after walking through all of these mechanics, the single most important action you can take is to consciously shift your focus away from that number. Chasing a price target is a strategy for gamblers, not for builders or long-term investors. Your focus should be on the principles, not the price. The principles are the timeless truths of the network that we have discussed: the principle of absolute scarcity, the principle of decentralized trust, the principle of predictable issuance. A price is a fleeting, temporary consensus. Principles are permanent. This shift in perspective is what separates successful, long-term participants from those who get washed out in the market cycles. Those who fixate on price are driven by greed and fear. Those who focus on principles, however, operate with a different mindset. Therefore, the next step for any beginner or miner is an internal one. It is a commitment to learning over speculating. The $250,000 figure is useful only as a signpost that points toward a powerful underlying trend. Your job is not to chase the signpost. Your job is to understand the road it is on. Section 2. Your first steps. Practical skills for every beginner. Once you have committed to learning, the journey becomes one of acquiring practical, hands-on skills. The first and most critical skill is learning about wallets and custody. This is the meaning of the popular crypto mantra: not your keys, not your coins. Start small. Set up a non-custodial software wallet. Send a tiny amount of Bitcoin. Experience the process. Learn how to back up your seed phrase. Write it down on paper and store it in a small safe. Never store it digitally. After mastering a software wallet, you can explore the next level of security: a hardware wallet. Again, start with a small amount and practice sending and receiving transactions. Learn the process of verifying your receiving address on the device itself. Section 3. The miner's path. From hobby to sustainable operation. The first step for any aspiring miner is not to buy the most powerful machine, but to learn the fundamental math of mining profitability. The single most important variable is your electricity cost. If the numbers do work, start small. Do not invest your life savings into a garage full of miners. Buy a single efficient previous generation machine. You will learn how to set up the hardware, configure the software, connect to a mining pool, and manage the heat and noise. The long-term miner's mindset is about consistently acquiring Bitcoin at a known cost rather than gambling on its future price. Your cost of production becomes your baseline. Section 4. The real takeaway. Education over speculation. The possibility of Bitcoin reaching $250,000 is a fascinating outcome. It is a possibility, but it is not a promise. The real promise of Bitcoin is not a specific price target. It is the opportunity to participate in a fair, open, and transparent financial network owned by no one and available to everyone. Your primary investment should be in your own education about Bitcoin. Knowledge cannot be lost in a market crash, and its value compounds over time. For beginners, learn how to buy a small amount, withdraw it to your own wallet, and secure your keys. For aspiring miners, calculate your electricity cost, understand the economics before buying any hardware. The Bitcoin journey is a marathon, not a sprint. 250K is one potential mile marker on a long road. Education beats prediction every single time. Build your foundation on knowledge, act with prudence, and you'll be well prepared to navigate the exciting road ahead, no matter which path the price takes. Hit the like button and subscribe.